All right, most people walk into a bank like they're asking for permission to live their lives. They hope that their credit is good enough. They hope their income is high enough. Hope is just not a strategy. The bank does not care about your hopes. They care about math and only math. Today, I'm going to give you the exact scorecard the bank uses to judge you. I will show you the 5 things that actually matter so you can stop guessing and start closing. Let's get to work. All right, step 1 is a mindset shift. Most of you are terrified of the mortgage process because you think it is subjective judgment of your character. It isn't. To a mortgage underwriter, you are not a human being. You are a series of ratios and risk factors. If your numbers fit in the box, you get the house. If they don't, you don't. The reason people get denied isn't usually because they can't afford the house. It is because they didn't know how to present their data. Today, I'm going to show you how to build a profile that makes it impossible for a bank to say no. We're going to cover the 5 pillars of qualification. If you master these, the rest, it's just paperwork. Credit score. First, let's talk about credit. Your credit score is the entry fee for the game. If it's too low, you don't even get a play. But here's the thing. A lot of people think good credit is enough. In the mortgage world, there is a good and then there is an optimal. A 680 score, that'll get you a loan. But a 740 score, that'll save you $200 a month for the next 30 years. That is $72,000 in savings just for having a better credit score. Stop looking at Credit Karma. That is a different model. You need to know your FICO mortgage scores. If you have late payments in the last 12 months, you're a red flag. If your credit cards are maxed out, you're a red flag. Your scores tell the bank if you are a person who keeps your word. Clean it up before you apply, not during. All right, debt to income ratio is the second pillar. DTI, debt to income ratio. This is the one that kills most deals. The bank does not care how much money you make. They care how much you have left over after you pay your bills. They take your total monthly debt payments, your car, your student loans, your credit card minimums, and your mortgage. And they divide that by your gross monthly income. If that number is over 43% or near 50%, you're a no for most programs. Here's a pro tip. If you want to buy more house, stop buying more cars. A $600 car payment can stop you from qualifying for an extra $100,000 in mortgage. You have to choose. Do you want to look rich in the driveway or actually be wealthy in the house? All right, income stability rule. The third thing you need to know is that most banks love boring people. They want to know that you've been doing the same thing, or at least been doing the same thing for the last 2 years. If you're a W-2 employee, this is easy. If you're self-employed, this is where it gets tricky. Self-employed people spend all year trying to pay as little in taxes as possible by claiming every deduction known to man. This, great for the IRS, terrible thing for the mortgage. The bank qualifies you based on your net income after those deductions. If you made $200,000 but wrote off $150,000, the bank thinks you only made $50,000. You cannot have it both ways. If you want a big mortgage, you have to show a big income on your tax returns for at least 2 years. Next is assets and sourcing. That's your paper trail. The fourth pillar is your assets. You need a down payment and closing costs, but more importantly, the bank needs to know exactly where the money came from. This is called sourcing. You cannot just show up with $50,000 in cash that you've been keeping under your mattress. If it hasn't been in the bank account for at least 60 days, it doesn't exist to the underwriter. They are looking for seasoned funds. If you are getting a gift from a family member, there is a specific way to do it. If you sold a car, you need a bill of sale and a copy of that check. Every dollar that goes in your bank account during the process will be questioned. They'll be scrutinized. So keep your bank statements clean. Stop moving money around like a shell game. That creates absolute chaos for us. Pillar 5, pre-approval versus pre-qualification. Here's the final thing you need to understand. The difference between pre-qualification and pre-approval. A pre-qualification, that's us guessing. It is you telling a loan officer your numbers over the phone and them giving you a piece of paper that says, yeah, that sounds pretty good. It is not worth nothing, but a pre-approval is a commitment. It means a professional has actually looked at your tax returns, your bank statements, your credit report. In a competitive market, a pre-qualification is a waste of everyone's time. You need a verified pre-approval. Qualification is about being prepared. It's about doing the work before you find the house. If you do these 5 things, the bank won't just say yes, they will compete for your business. Stop being a victim of the process and start being the one in control. If you're ready to see where your scorecard stands, let's talk. All right, so now that we've got income and assets, our credit, our sourcing dialed in, and really how we're managing our assets, right? So we've got the big picture in place. So now what I'm going to do is we'll flip to the whiteboard and we'll just run a simulation to see what it looks like from our perspective to get a mortgage payment rolling. All right, my friends. So let's just run a simulation and see where it takes us. So you make $120,000 a year. Simple math, okay? That's $10,000 a month, okay? So in my world, we can use up to 50% of your gross income on all debts. So to keep it simple, 50% of $10,000 is $5,000. This, if you have zero debt in the world, is what you can use on a mortgage, okay? Just for qualifying purposes. But let's simply say you have a $500 car payment. Got it? Let's say you have a $200 student loan payment, okay? Let's say you have a $300 credit card bill. Credit card, right? So we simply do it this way. And yes, I made it simple. $5,000 minus 5, 7, 1,000, right? So our total debt is $1,000. So this is how we do a mortgage. This is how we calculate your mortgage payment. $5,000, which is 50% of your gross income, less all of your debts. This means this can be your subject mortgage. It's really that simple.